I'm on a mission to change the way that you think about trading. And when I say that, I don't mean any kind of woo-woo, envision your dream life and now manifest a Lambo type of bullshit. I'm talking about something much more important, which is perspective. And here's why. When you look at all the problems that most traders go through, the type that stop you from ever succeeding at this, when you drill down to try and find the root cause behind them, a lot of them tend to relate to the exact same problem. Having the wrong perspective about what trading is all about, and therefore what you need to focus on if you want to succeed. And usually this means that traders are doing the wrong things. So if I can help you shift your perspective, everything else should change as well. You'll start focusing on the right things, developing the right skills that most traders don't even realize that they need. And finally, get yourself on a path that could actually give you a chance for succeeding at this. And that means leaving behind all of the bullshit you see throughout the industry that just holds people back, and instead focusing on building the skills that matter. And all of this connects with what we discussed in the last video. I told you then that these videos were connected. And in that video, I explained that there are 3 mental shifts that can change the way that you think about trading. And the first one was what we discussed in that last video, the idea of implicit statements. Now, if you haven't seen it, then I recommend going and watching that video so you can understand it fully. I'll put a link in the corner up there or in the description down below. But let me just give you a quick recap so that we're on the same page here. So the idea of implicit statements is basically when you make a decision or take an action in the markets, you're making a statement. Whether you realize it or not, you are making a statement through that action. But the problem is, if someone came along who knows nothing about your trading and explained to you objectively what statement your action is making, most traders wouldn't agree with it. It wouldn't match what they believe to be true or what their intention was. But in the markets, your actions speak louder than your intentions. The market doesn't care what you intended to do, what you're meaning to do. It's just what you actually do. So if you're meaning one thing, but your actions are stating another thing, you're going to end up with unintended consequences. And in trading, unintended consequences usually means that you're depending a lot more on luck than you should be, and a lot less on skill. That concept of implicit statements connects directly to the next 2 mental shifts that we're going to be talking about today. And those are probabilistic thinking and forecasting the markets. Now, before you click away thinking, yeah, I already know trading's about probabilities and obviously we're forecasting the markets, hold on, because what I'm going to explain to you in this video is probably not what you expect. Because even among traders who understand and accept that trading is about probabilities, I still see the same problem. That they only apply that idea, that way of thinking, selectively in certain parts of their trading and miss out of other huge parts where it should apply. And that completely changes their results, their progress, their performance. And the same goes for forecasting as well. I definitely think that's one area that traders don't think deeply enough about what that actually means if you're forecasting the markets and the logic behind that, what you should therefore be doing. But the good thing is these 2 concepts are directly connected. So once you understand one of them in a different way, hopefully in the right way, it also changes the way you think about the other. And so you start making improvements on both sides, and that's when things really start to shift with your trading. So I'll explain all of this step by step throughout this session, and I can already tell you it's probably going to be a long one, but please stick with it, even if you watch it in more than one sitting, because I'm certain that you'll come away with at least one big shift in how you see trading. And as I've said in previous videos, some of this goes against the conventional thinking that you see throughout the industry, but rather than just disregarding it because it's different to what you've heard before and maybe it sounds a bit complex in places, just try your best to follow the logic. Rewatch it again if you have to, ask questions in the comments, but try to understand it fully. Now, just quickly before we get started, if you look in the description box, you'll see a link there to sign up for my free newsletter. That's where I send more of my insights and lessons from over 20 years in the markets, including breakdowns of some of my trades. Just the other week, I sent a 1-hour video breaking down all of my trades from the previous month, including the analysis, the entries, the decision making, all of it. And it's completely free. So even if you've got no intention of learning from me, you think I'm an asshole, but you're just curious about what I send, you might as well sign up. There's no cost, and chances are you'll pick up something useful from it. But anyway, let's get started. So I think the best way to begin is by quickly recapping something we covered in the last video, because this is the foundation of everything we do in trading, and so it directly connects to the concepts we're talking about today. And this is the most important statement that we make as traders. At the point when we're opening a trade, what statement are we actually making when we call something an opportunity? So if you look on the left-hand side of the screen, I've mapped two potential outcomes here, outcome A and outcome B. And this is just a random chart. I haven't picked it for any specific reason. And for simplicity, I've defined the outcomes as being based on the swing high and swing low, but don't read too much into that. It's just to illustrate the point. So we can think of these as being the first order outcomes, the immediate things that could happen next. And in this example, outcome A is 30 pips and outcome B is 10 pips. Now imagine we picked this entry completely at random. We set a timer, waited for it to go off, and then flipped a coin to decide whether to go long or short. So we have absolutely no advantage. So if we take that trade with no edge, no advantage, what can we expect the probabilities to be of outcome A or outcome B happening? Well, in this case, the probability of outcome A is 25% and the probability of outcome B is 75%. So another way to think about this is by looking at the trade expectancy calculation at the bottom of the screen. So a trade expectancy calculation is basically telling you if you took this type of trade again and again and again, on average, what return can you expect per trade? Okay, so if we take those numbers that we've just discussed and put it into that calculation, we'll see that the expected value comes out as 0. In other words, there's no advantage. On average, you would expect no return. So at Duomo, we call these probabilities, when there's no advantage, the base rate. So if we're entering a trade, we're obviously not doing that if we think we have no advantage. So in that case, what statements are we making if we do enter a trade? Well, if we're going short, we're basically saying the probability of outcome B is higher than 75% and outcome A is lower than 25%. That's what would make it a positive expectancy trade. So if you took those numbers, put it in the expectancy calculation, you're going to get a positive number, meaning on average, you're going to make a profit from those trades. And on the other hand, if we're going long, we're saying the opposite. We're making the statement that outcome A has a greater probability than 25% and outcome B has a lower probability than 75%. Hopefully everything I've explained makes sense to you. I think it's quite straightforward, but maybe watch it again if it's not clicking for you right away. And if you've watched my videos before, you're probably bored of me explaining this, but it's so important. I want to make sure it's drilled into every trader. But what we've looked at up until now is just an individual opportunity. Now I want us to take it a step further and think about what this means for longer term performance. And now I'm going to say something that I already know is going to sound very harsh, but it's also absolutely true and the statistics back it up. So if you think about all the traders around the world, almost all of them, when they click that button to enter a trade, are doing so because they think they have some sort of advantage. Otherwise, why would they enter the trade? They think they're predicting something. Now, obviously, there are also out and out gamblers who don't think they have an edge and just want the thrill of opening a trade, but those aren't really traders. And likewise, when most of these traders are spending their time doing their analysis, they'll do that because they think they're picking up on meaningful information. They think they're detecting important things that have an impact on the market and have some sort of predictive power. Otherwise, why would they spend their time doing it? But the unfortunate thing is that for most traders, all of that is a complete waste of time. They are not analyzing anything meaningful. It's not important. It's just noise. There's no predictive power. They're just falling for clustering illusions and false causality. They're not predicting anything with it, which means the trades that they think they're entering with an advantage are actually no better than just flipping a coin and choosing heads or tails, long or short. It's all based on luck. They think they have an edge, but really they're just trading the base rates under this facade of doing something structured. And if your probabilities on average are just the base rates, your expectancy is 0, which leads to the big question. How would that impact your long-term performance? So if you're opening trades with no advantage, an expected value of 0, you can't expect to do well over the long run. Your performance is entirely based on luck. You'll get some profitable streaks, but it's sort of like using a sieve for a saucepan. Your profits just won't stay for long. They'll be wiped out by losing streaks, and overall, the long-term return will average out to being 0. And the only way you make money in that situation is if you happen to stop trading right in the middle of a good, lucky run, cash out and walk away forever, go and retire on a beach somewhere. But obviously that's not a great plan for your trading career, and I'm sure if you're watching videos about trading, you're not intending to just go on a lucky streak and then give up. Now, these charts that you see on screen are just to demonstrate the point. I'm not suggesting that every trader in that left-hand chart converges to a return of 0 at exactly the same point. But what I want you to get from this chart is that, yes, there'll be profitable streaks and losing streaks, ups and downs, but there'll be no positive long-term performance, nothing dependable that you can actually rely on. So then what's the point of doing it? And most traders who are making profits right now are simply on the upwards part of this cycle without realizing it. They think they've tapped into something that's working when the reality is they're just on a lucky streak. But you might think, well, what's the problem with that? If there's no advantage or disadvantage, you'll just be at break even. Like, doesn't matter that much. But that's also not the case, because with every trade we open, we also pay a transaction cost. Things like the spread, commission, swaps. So imagine, without transaction costs, maybe you have one trade that makes a profit of 1%, and then the next trade loses 1%, so you're back at break even. But when you factor in the transaction costs, the profits are obviously a bit lower and the losses are going to be a bit bigger. So with the same trades, you're going to be below break even. And when that plays out over the long run, what originally would have had you averaging a return of 0 is now putting you into an ever-growing loss. And this is the real reason that most traders lose. When you look at the industry statistics, whether you believe it's 95% of traders losing or a bit less than that, 90, 85, whatever, it's not that all of those traders are taking negative expectancy trades, it's that they have no edge either way. They're trading based on the base rates. It's like flipping a coin, but they're losing because of the accumulation of transaction costs. And I see some really terrible advice throughout the trading industry, but one that I've seen coming up time and time again is people suggesting that you can just keep trading, keep collecting that data, and if you're profitable, great, now you've got a profitable strategy, you just keep doing that. And if you lose, now you can start doing the opposite and you'll have a profitable strategy instead. But this is complete fucking nonsense. If you have an average expectancy of 0 and you're losing in real money due to transaction costs, guess what happens when you start doing the opposite, when you start trading the opposite way? Well, the outcome will be exactly the fucking same. Listen, I just wanted to come back and quickly add something here, that obviously a lot of the traders that lose are doing so because they're risking too much money, being over leveraged, or holding on to losing trades way beyond the point they should have exited them because they're hoping it eventually comes back to being profitable, but then it never does. So those traders never get to the point where they see their probabilities playing out, but those aren't really the traders I'm talking about. Instead, I'm talking about the traders who feel like they're doing things the right way with appropriate risk management and all things like that, but still don't succeed. Now, I know that it can be difficult to accept that this may also be the case for you if you're currently losing with your trading, because everyone is so persuaded that their analysis and their strategies are meaningful and the problem is something else. Because it's really hard to accept that something you've been learning, something you've been spending time doing, is contributing nothing more than a coin flip would. But don't worry, I also have some good news for you. Because making money from your trading in a dependable way over the long term is actually simpler than you think. Well, it's also a bit more complex than you think as well, but the first part is simple at least. It basically comes down to this. Your average positive expectancy, in other words, the advantage that you have over the base rate on average with your trades, just needs to be higher than the average transaction costs. So here's a simple example just to illustrate that point. I'm not saying it's exactly like this, but I just want you to understand the logic. So let's say that your average transaction cost is 1 pip, but your average trade expectancy is 5 pips. Then congratulations, you're going to be making money overall, assuming all else is equal, like position sizes on the trades and that kind of thing. But obviously, this is only going to be the case if that's genuinely the level of positive expectancy, because it's one thing for me to decide a trade is positive expectancy, but that doesn't mean it actually is. And so we can think of this with different numbers as well. Let's say that your average edge, so your average expectancy, is just 1 pip, right? So you're still technically a profitable trader, but if your transaction costs are also on average 1 pip, you'll be breaking even. Now, once again, this is all massively oversimplified. Real trading is much messier than this and the numbers won't be so straightforward. But I'm pointing this out to you so that hopefully you just get the idea. Because imagine your average expectancy is 0 because you're trading at base rates and average transaction costs are 1 pip. After 1,000 trades, you've just paid out 1,000 pips. That's significant. But I want you to notice that here we're talking about averages. Because here's the thing. Not all of your trades need to have an advantage. Of course, you wouldn't open them if you didn't think they did, but just because you think there's an edge doesn't mean there actually is. So it's inevitable for every trader that some trades that you take won't be positive expectancy. So imagine only a quarter of your trades actually have positive expectancy, and the rest we can assume on average have an expectancy of 0, no edge. Now, it's important to understand here that this doesn't mean all the positive expectancy trades result in a profit, and it doesn't mean all of the ones with no edge result in a loss. Both types will have both profits and losses. But overall, the ones with positive expectancy will make a profit over the long run, over a larger sample size, and the ones with no advantage won't, at least not in a dependable way over the long run, something that you can rely on. So if we imagine the trades with no advantage more or less balancing each other out over time, so you don't make anything, you don't lose anything, then all you're paying out is the transaction costs. So therefore, you can still make money from your trading as long as the ones with genuine positive expectancy make enough for profit to exceed the transaction costs on all of the trades. So if you take a look at the chart on the right hand side, I've put this here to try and help demonstrate the point. It's obviously not entirely realistic because, well, a few reasons, but one of them being that it suggests all the trades are happening at once and that there's the same number of those trades and so on and so on. But it's just to help you think it through. And I want you to think of it this way. The red line is from the trades where you have no advantage. So sometimes it's a profit, sometimes it's a loss, but overall it's drifting downwards because of the accumulation of those transaction costs. So it's a deepening loss. The green line, on the other hand, are the ones with positive expectancy. Again, some of them will be losses, some of them will be profits, but overall, because it's positive expectancy, it's going upwards. And when you take them both together, what you end up with is the yellow line, which is the overall P&L with all of the trades combined. And once again, this is not an accurate depiction. It's not intended to be completely accurate, like this is what it looks like. I'm just putting this here to help get the point across. I do still know that I'll probably get destroyed in the comment section because why the fuck not? That's what people do. But anyway, hopefully that helps you get the point. So let's stick with this example where only a quarter of your trades genuinely have positive expectancy. So if that's the case, how can you improve your profitability? Well, there are two broad ways that you can do that. The first is to obviously increase the number of trades that do genuinely have positive expectancy, therefore trading more based on skill and reducing the amount of luck involved. All right, just another thing I quickly want to add here because it's important. I'm not saying that you'll know which of your trades actually does have positive expectancy or not, because obviously if that was the case, you wouldn't take the trades that don't. You only really find out your accuracy levels by going through a calibration process, which is something I explained in a previous video, and I'll chuck it up there in the corner so you can go and watch that if you want to. And the second way is to increase the size of the advantage in the positive expectancy trades. So how far from base rate the estimated probability is. Now, I can already sense the complaints about that second one coming my way, because how can you increase the advantage when you don't control the markets? The probabilities of a situation are the probabilities. You can't increase them unless you're just fooling yourself, but that's not going to improve your profitability. And all of that is true, but it's also not what I'm suggesting. You do it by increasing the threshold for what you count as an opportunity. If you'd previously look at something that has a positive expectancy above 0.2R and count that as an opportunity, you might now change your threshold to only take trades when the positive expectancy is over 0.5R. In doing so, the trades that genuinely have positive expectancy will have a bigger advantage, and the ones that are just the base rates end up being more or less the same anyway. Now, regardless of which of these ways you're aiming to improve your profitability, it's going to come down to the exact same things. So when you improve one, you improve both of them. And those things are doing better analysis and being more accurate with your probability estimates. And for a lot of you, that's going to mean actually going through probability estimates in the first place. And yes, it is possible to get more accurate with your probability estimates. I've shown this in previous videos. I won't be going into it in detail today, but it is a recurring topic on this channel. So if you don't want to miss any future lessons, make sure you subscribe and switch on notifications, or sign up for the newsletter, and then you'll get all other training videos as well that will walk you through this. All right, now before anyone says anything, no, I'm not doing an outfit change for each different segment like I think I'm fucking Taylor Swift or something. I've just had to come back to film the rest of this video on a different day. So there's your explanation. So what we've covered so far is all about probabilistic thinking. I think most traders accept that trading is about probabilities, but usually only to the extent that they accept that each trade could result in a loss. But hopefully you can see now that it goes much further than that, and it should be a much bigger focus in everything you're doing. And there are also many other ways that probabilities impact other areas of your trading, things that most traders completely ignore. And these can completely change your performance or the decisions that you make that impact both your individual trades and your entire trading career. But we will go deeper on all of that in the coming videos. I've got a lot of things planned. But for now, I want us to expand on what we've been discussing so far and look at how that impacts the way that we analyze the markets and find trades. So let's think back to that example that I gave you earlier when we talked about what makes an opportunity. We had two potential outcomes and we were talking about the probabilities of each of them. So when you have a range of potential outcomes and you estimate the probabilities of those outcomes, what you have is a forecast. Even if you just conclude that the probabilities are the base rates and that there's no advantage, that is still a forecast. Therefore, a trade opportunity isn't necessarily a setup or when the market matches your entry criteria or any of the other things that you've been told to look for. A trade opportunity is simply a forecast that you estimate has positive expectancy. And so this leads us to an important conclusion. If a trade opportunity is just a forecast that you think has positive expectancy, that means technically you could be forecasting in the markets continuously and just take trades when you see that there's positive expectancy. Now, in reality, it doesn't make sense to constantly forecast the markets because, like, what are you going to do? Update your estimates every single time the price ticks up or down? It'll be fucking insane. So instead, we look to forecast when each potential outcome completes and we've got new potential outcomes, or when certain things take place in the markets that gives us new meaningful information so that we can update our forecast in a material way. So not every single price tick, but when there's something more substantial. So take the example on screen. It might be the case that each of the markers that you can see were moments where we could complete a forecast or update a forecast. The ones in red had no advantage, meaning we estimated that they were either at the base rate or below the expectancy threshold, like we discussed a moment ago, the threshold for taking an opportunity. Whereas the green ones were positive expectancy above the threshold and could be taken as trades. And this is exactly what we do with the Duomo method. Yes, we still use setups for timing and entry, and that's for two reasons. Firstly, because it's a tipping point for the probabilities, as it's the moment that we expect a shift in activity to happen. And secondly, because of what I explained in the last video, that it's an optimal point for expectancy. But the opportunity itself doesn't come from a setup. The opportunity comes from the forecast, and that's derived from something else. But the problem is that most traders don't put themselves in a position to even be able to do this. And let me give you a simple analogy to explain why. Think about weather forecasting. So throughout history, people looked up at the sky or the world around them for different cues that would help them to predict what weather is coming their way. And this is known as weather wisdom. You might have heard of famous sayings like red sky at night, sailor's delight, or shepherd's delight, or as a kid I thought it was angel delight. That's weather wisdom, right? Assigning context to observed patterns and then looking for those same patterns again in the future and assuming the same context. And actually some studies show that there is a certain level of accuracy to these forecasts because they reflect real atmospheric patterns. But they're also too simplistic and too context dependent to be consistently relied upon. In some situations, they'll be amazingly accurate, but in others, they'll come to the completely wrong conclusion. So imagine that you had a weather app and it was all just based on weather wisdom. How much would you trust in what it shows you? On the other hand, when we look at what weather forecasting is like these days, weather forecasters rely on a huge amount of very accurate data points, which they then run through complex computer systems to produce these incredibly accurate probabilities that you see in the weather apps, like the chance of rain and things like that. They don't assign meaning to predefined patterns. They look at each situation uniquely and try to understand the specific context of that moment. And this is exactly what you see in trading as well. Most traders rely on a predefined set of factors that they've already given meaning to. These are based on previous observations that they've made, or just what's been passed on to them by another trader or whoever it is that they're learning from. Then they analyze the markets looking for those specific factors, and when they do come up, maybe in a particular order or a sequence, they'll assign a predefined context to them. They've already assumed the meaning. So they're focused on a small amount of information and have already decided ahead of time what that small amount of information will mean and what it will mean for the next price movements. They've already assumed the context for those situations. But if we already know how important probabilities are for profitable trading, we need to be as accurate as we can in how we estimate them. This can't be done by just packaging up the market into these neat little boxes that we assign some meaning to. The markets are dynamic and each situation that we see is unique. Now, of course, there'll be many similarities, but there will also be many differences as well. And those differences matter just as much as the things that are similar. So the only way that we can increase the accuracy of our forecasts is by analyzing and interpreting all meaningful information and coming to a unique conclusion about the context at that moment in time. But that's just not possible with how most traders approach the markets. And that's exactly why they end up taking trades where they think they have an edge, but actually have no edge at all. Now, I do realize that all of this might sound a bit abstract at this point. So I want to start getting into some of the specifics so you can fully understand what I'm explaining to you here. So let's start off by thinking about what most traders do. And you might even be doing this yourself, especially if you're following some sort of strategy. So there'll usually be a sequence of things that you look for. In this case, it might be that X is looking at a higher time frame to see if there's a particular type of trend or structure that tells you something about the market. When you see that particular trend or that structure, then Y might be waiting for a particular cue on a lower time frame that tells you something else. And there are all kinds of popular ones these days, like fair value gaps or liquidity sweeps. And then Z might be the price returning into a certain area. And this final step tells you that the market is ready to sell off or to shoot up. So you enter a short trade or a long trade or whatever it might be, and away you go. Obviously, those elements are just an example and quite vague examples, because I don't want to take something that's real and throw someone under the bus by using them as my example of what's being done badly. But you can think about your own trading and just swap any of those predefined things that I've mentioned for any other predefined thing that you're using or that you see any other traders using. And it doesn't have to be 3 steps like this. It could be any number of steps in the sequence. But essentially, it all means the same. It means that you're already deciding the meaning this combination of different things gives you without taking into account all the unique aspects of that situation. You're saying because X, Y, and then Z happened, it means the market is doing this, so the price is likely to do that next. But that means you're not really assessing all the factors that make up that unique situation. And as a result, your probabilities are very unlikely to be correct. And in fact, most traders don't use probabilities. They rely on success rates, meaning they do their back testing and see how many times that particular situation was profitable in the past, and then assume that that's the rate it will be profitable in the future. But success rate is not the same as probability. Now, I've used this analogy many times before. I'm a creature of habit. I'm going to use it again. But let's say I wanted to know what is the chance of it raining today. Now, I can look back on previous data and I can see that it rained in London over 140 days last year. And yes, that's true. That's quite depressing. So that's like, let's say around 40% of the time. So I can say there's a 40% chance of rain today. Now, that's the equivalent of what traders are doing when they use success rates. But hopefully, in this context, you can see how it's completely fucking ridiculous. What if it's a clear sky today? What if there are dark clouds over? What if it's mid-July? What if it's mid-February? It's obvious that it's not going to be a 40% chance every day. The context matters. And for your trades, there are also all sorts of differences that change the context. Not to mention the fact that the sizes of the potential outcomes will be different each time. And listen, obviously I completely understand the desire to keep things simple with your trading. But the problem is, a lot of the people in this industry who tell you that you only need to keep trading simple and teach you these simple approaches are just following simple marketing tactics. Make something sound effortless, easy and quick, and you'll get lots of people on board. Fuck it, it pretty much does it itself, it's turnkey. But remember, our job as traders is to forecast the global financial markets. If you're just spotting, plotting, and labeling things, and then assigning some predefined context that some over-the-top flashy twat on Instagram has given you, do you really think that's enough? Do you really think that's a skill that 95% of traders fail at? Or do you think that maybe most of those traders fail because forecasting the global financial markets involves more skill than that? Of course, it's easy to blame trading psychology for people losing. It's easy to blame people not using good risk management. But a simple fact is that most of the time is that you just don't have an edge. Most trading psychology problems exist when you don't rely on the correct skills, and they go away when you do. Now, don't get me wrong, at Duomo we do also look at structure, and we do also apply simple logic to certain situations. Like we might look at a higher time frame for a particular shift in structure and know that that's now the trigger to go and analyze deeper to understand what's going on. But those are more like cues to go deeper. The real analysis is always done by breaking down the specifics of that situation and understanding what it's really showing you. So how do you start making these improvements in your trading approach? Well, first, you need to understand what information is important. And these are the core foundations that I think most traders tend to miss. So this diagram here is what I call the market context hierarchy. And don't worry, I'll explain each of the segments to you in more detail. But if we look right at the bottom, there's the raw input. It's the main information we get about what's happening in the markets, and that is transactions. And we can also put potential transactions in this category as well if we include the order book. So when a trade happens, what information exists? We know the price the transaction happened at, the quantity, the time, and often what side of the book it was executed on. Now that's a very small amount of information. Can I understand what's happening in the market from any individual transaction? Maybe very occasionally, but not usually. But groups of transactions together give us an entirely new meaning. And I refer to these groups as activity. And there are all kinds of variations of activity. But as you'll see in a moment, there are still only a limited number of things that we can read from activity. So there are more possibilities and variations than the individual transactions, and we can get more meaning from that. But it's still not enough to fully understand the situation. But groups of activity together give us the market context. And here there are pretty much infinite variations. Every single different group of activity gives us a unique market context. And it's by understanding that context for that specific situation, that we can create a reliable forecast. And remember, a trade opportunity is just a forecast that we estimate has positive expectancy. So a simple way to think of all of this is that transactions are like individual words. They say something, but you can't really understand much of them on their own. But a group of words together can form a sentence, and that carries more meaning. And when you have groups of sentences together, you can fully understand the context of something, whether that's a paragraph or a whole novel. But what most traders are doing is packaging up certain types of activity and saying, here, this is the context every single time that these happen. It's like when I was a kid going on holiday, memorizing things from a phrase book when I was on the plane, thinking that when I land, I'll be able to talk to people in that language. Like, even if I hear the phrase that I think I recognize, it doesn't mean that it's in the right context. Just think about when your girlfriend tells you, don't worry about it. That might mean that you can chill out and genuinely not worry about it. Or it might mean you're in a doghouse. And trust me, you're asking for trouble if you don't get the context right when she says that. So let me explain each of these segments to you. I'm just going to do a quick run through so that you can understand the basics, but I can always do a follow-up video for each of them to explain things in detail at a later point in time. But for now, we'll just do a quick once over. First, we have transactions. It's really important that you understand how trades happen and what causes prices to move. Hopefully you know this already, but if you don't, you're not alone. It seems most traders have never learned this, which is really surprising. So I'll give you the very simple version for now, just so you broadly get what's going on, and then we'll go into more detail in a separate video. So we can think of there being two broad types of orders in the markets. There are limit orders and market orders. Limit orders come under different names. You often hear them referred to as resting orders or a whole bunch of other specific types. But basically, a limit order is where a trader is saying, I'll transact this quantity at this specific price or better. So if the market doesn't reach that price, their order won't be filled. And if it does, great, they'll maybe get their order filled. On the other hand, a market order is where a trader says, I want to transact right now with this quantity, right now at whatever price I can get. And this is the type that retail traders usually use the most. So we can think of limit orders as being the more patient, more passive type, whereas market orders have more urgency and are more aggressive. They just want to get filled right now. Now, limit orders will appear in the order book. You'll see these in the depth of market, things like that. And you can think of the order book sort of like advertising. So these traders are saying, hey, look, I've got this quantity to transact at this price, like advertising the trade. And they'll either be on the right-hand side of the book, meaning that the orders are looking to sell, or the left-hand side where they're looking to buy. So these limit orders are the liquidity in the market. And this liquidity is then taken by the market orders. So if I have a market order to buy in the market, I'll transact against the limit orders, liquidity, on the right-hand side of the order book. Whereas if I have a market order to sell, I'll be transacting against the orders on the left-hand side. And this relationship is what leads to prices moving in the markets. So let me give you a simple example. Let's say that I'm executing this market order to buy 120 lots of a particular asset. So I now need liquidity to transact against. At the price 1.356, there are 50 lots available. So I'll transact against those. And so the price is at 1.356. But I still have 70 lots left to transact, so I need more liquidity. So now price moves up to 1.357, and I take the 60 lots available there. But my market order still has 10 left to transact. So price moves up again to 1.358, and I take 10 of the 40 there. So price has moved up as I found the liquidity to transact my market order. So this means prices move based on imbalances between volume, the market orders, and liquidity, the limit orders. The bigger the imbalance, the more price will move. The lower the imbalance, the less it will move. And if it's balanced, it won't need to move at all because there's enough liquidity at the current prices to transact against. Now, that's a really overly simplified version. It's a bit more complex than that in reality. There are many other things going on. I mean, markets are usually a continuous double auction process. So there are these transactions happening on both sides. But just like I mentioned before, I'll explain all of it in much more detail in a separate video. For now, I just want you to understand that when we're talking about transactions, it's this process that's happening. And this is some of the information that you look at when you're doing order flow analysis, which is something that we use to support what we're doing with the Duomo method. So it's like an extra way of us analyzing deeper in the markets. But the thing is, you can't understand the full context just by looking at transactions alone. So let's move on to the next segment, activity, which is what we get from groups of transactions. So the levels of balance or imbalance at different points in the market, where those change and where they're likely to change in the future, gives us a lot of information about what's really going on. And these are basically the movements that we can see happening visually on the chart. And I think of them as contextual factors. But when you really think about it, there are only really a limited number of things we can actually pick up on. We can see where turning points happen, where consolidation happens, how much momentum there is behind a move, the size of a move, the depth of pullbacks within a move or within a trend, the level of volume. And if you're using the depth of market or other similar tools like Bookmap and things like that, you can see the orders or liquidity. There really isn't anything else we can see in the market. Everything is just derived from some combination of those factors. But there are endless variations that we could see in each of these individual contextual factors, and those variations give us a lot of information because they're telling us something about the balance or imbalance, who's in control in the market, and where there have been shifts in activity, which is all useful information for understanding the full context of the situation. So for example, when we're looking at turning points, reversals in the market, we have where the turning point happens, how quickly it takes place, how strong the move away from it is. We have different levels of momentum. Like think about how quickly the price moves from point A to point B. That's telling us something about the composition of that move, the level of imbalance that's causing it. And what about depth of pullbacks? What's it telling us if it's just a small fluctuation compared to actual waves? What if there are no pullbacks at all? Then we've got the size of the move. Why were there bearish moves like this at this point, and then this one was much longer? What changed? Why did it change? Or with consolidation, where does that consolidation happen? How tight was the consolidation? How long did it last? every single time that we look at the markets, there's a different unique variation of these different contextual factors. And together, they give us the narrative of what's been happening so far and allow us to interpret the current situation, to paint a picture of what's been happening and what may happen next. And by the way, all of these that we've just been through will allow you to understand what's happened in the past. But to be able to anticipate what may happen next, to plan the potential outcomes, and therefore to be able to trade well, you need to be able to anticipate where future shifts in activity will take place. And to do this effectively, you need an underlying market theory, like the Duomo market theory that we use, because you need to anticipate why price might shift at a specific point. Like, why that point and not 5 pips before or 10 pips after? What is it that makes that specific price point the place where the activity is going to shift? And that includes something that I call invisible levels, which is anticipating where shifts in activity may happen at price points where the market has never been before. Because imagine that you're in a long trade and the market's reaching record highs, like if you've been long gold recently. How do you know where the end of that potential outcome is going to be? If you're just going to be reacting based on emerging price activity, you're likely to end up trading base rates. And listen, this is definitely something that we'll discuss in more detail in a separate video, because there are so many implicit statements related to this that traders just don't realize that they're making with their trades. And because of that, they end up relying a lot more on luck with their trades than they realize. And you're probably noticing I have a lot of videos planned. I've said this will be in a different video about 3 or 4 times in this, but that's because I've got a lot of videos on the way. So stay tuned, subscribe to the channel if you haven't, because they'll be coming thick and fast. But here's the thing I want you to understand. Rather than using the equivalent of weather wisdom and having a set of things that you look for with a predefined context, which will usually be wrong, we can use these activity types, the contextual factors, to understand what's uniquely going on in that situation, just like reading a book. In other words, when you're following a market and seeing the price movements developing, you can pick up on the information that that gives you and use it to update what you understand about that market. So here's just a basic example, only looking at price structure. And by doing this, it was actually possible to anticipate potential key turning points, even before adding any levels to the chart or anything like that, because that would all come after this. It's by understanding the underlying context first that you will know what type of levels will build on that context to show you the information that you need, rather than just adding levels arbitrarily just because they can be added. And by the way, I do have to point out that what you see in this screenshot is complete overkill. I've only done this to demonstrate the point about how much information there is even just from the structure characteristics. I'm not saying you have to cover your chart in information like this, but this is just the basics related to structure characteristics that you see in this screenshot. And I actually did all of this on a live stream with members of our community. It took about 4 hours, so it was a long session. And so from that previous information, I can then start explaining the context at certain points in time, or identifying interesting points where there was an interesting shift in activity where I feel that I need to investigate further to understand what's been going on, what caused it, why that point. I can then add relevant levels, and by doing this, I can fully understand the cause-effect sequence that takes place in the market. As a result of that, I can then anticipate the next potential outcomes and make very precise judgments about the probabilities of them happening. Now look, I'm just going to say it again, but don't get too caught up with the text that you see on that chart. It's just some basics to give you an example. I don't want you to take that and think, okay, that's what I've got to do. Like, that's sort of focusing on the superficial aspects rather than understanding the logic of what I'm explaining to you here. And there are much more nuanced things we could add to that chart. We could, of course, add key significant levels that explain the shifts in activity and could be used to anticipate future shifts in activity. But all of this is just a basic example. It's the premise rather than what you actually see in there. Because really what I want to get across to you is that there is so much information that we can get from each situation in the markets that will inform us about the probabilities of what may happen next. And if you don't pay attention to this information and just try to keep things simple by looking for a sequence of predefined cues and treating them the same way each time, you might be making things easier for yourself, but you'll also be making it far less likely that you'll actually have any kind of edge. And this applies to so many things that have become really popular over recent years. Things like head and shoulders patterns, which have been popular for decades, liquidity sweeps, wick fills, even simple things like swing high lows. Now, I'm not saying that these things are inherently useless or bad to use. I mean, at Duomo, we use swing high lows along with other types of levels and zones. The important thing is that you don't pre-assign some specific meaning to them, and that you understand what it is that they're actually showing you, or what they are meant to be showing you, and whether there's something better that could show you that in a more precise way. By thinking about that hierarchy of activity, you need to understand what they mean within the right context. Because let's think about the implicit statements that are being made with some of these different things. Let's think about a head and shoulders pattern. Now, I didn't want to throw anyone under the bus by choosing certain images and singling them out, so I just took the first 4 images that came up on a Google image search for this. I haven't chosen these ones for any particular reason. Okay, so if it's your image there, I'm sorry. But think about what statements are being made. Firstly, are all of these head and shoulders patterns the same? Do they look the same? Can we really treat them all in exactly the same way? And do all head and shoulders patterns really tell us the same thing about the market? What about the rest of the context? If we think about what a head and shoulders pattern is made of, if we break it down in terms of the activity types, the contextual factors, can't we deconstruct it and figure out the actual context each time rather than a pattern? Like, think about the activity types we have here. It's just a series of price moves and turning points that appear on the charts in a certain way. But what about the level of momentum in each of the price moves? What about how strong the turning point is? What if it consolidates in between? What about the pullbacks within the moves? What about where the turning points happen? How strong the turning points and all that kind of stuff. You see, it's not the pattern itself that matters. It's those factors. And by understanding how to interpret them, you can figure out the correct context each time. And as a result, you'll know when a head and shoulders pattern is more likely to work or not. Or you don't even need to rely on the head and shoulders pattern, because it's got nothing to do with the pattern and everything to do with the activity types that construct it. And if we treat the patterns the same each and every time, we're making the implicit statement that they all have the same context, that the variations of the activity types don't matter, that all that matters is the pattern itself. We're saying of all the endless types of context that we could have, every time there's a head and shoulders pattern, it specifically shows this, the same exact context every time. And that is just wrong. If you really want to understand what's going on in the markets, you need to break things down to first principles as much as you can. Deconstruct things to their component parts and focus on interpreting those. So think about what activity makes up this thing that I'm looking at. What is it that I'm really analyzing here? And is it really reflecting that properly? Quite a few years ago now, I put out a video explaining why traditional chart patterns are useless and have no predictive power. And it's been proven in many studies. And of course, as you'd expect, I got a lot of hate comments on that because people get really tribal about trading approaches and stuff. But the funny thing was the argument that people kept giving to defend chart patterns. They were saying things like, of course, when you just test patterns, they're going to give you bad results because you have to use them in specific situations after already analyzing the markets to determine that price is likely to reverse, and then just use the pattern as the trigger for entering a trade. Okay, so in that case, what do you think is more likely to be having the predictive power here? Is it this arbitrary pattern, or is it the rest of the stuff that you've used to interpret the markets and make up that forecast? It's like people can't see past the pattern or the other things they're using to realize that any success they're having is coming from the rest of the work they're doing. Because the thing is, if you stay in the markets long enough, even if you're doing the wrong things, you will develop implicit knowledge without realizing it. So you'll start detecting the activity shifts that we've been discussing, but not necessarily knowing that that's what you're detecting. You just get a feeling about things. You think it's this particular thing that you're basing your opportunity on, the pattern or whatever it might be, but then you can't quite explain why there are certain situations where you decide just to not trade it. But if you make these things more explicit by actually developing the skill of interpreting the context based on the overall activity, you'll be far more successful. But unfortunately, it always seems to be the case in this industry that people are too afraid of going against the crowd, thinking for themselves, questioning the logic, and questioning whether maybe some of these things that everyone is going on about are just false illusions. And it's just like the one that's become so popular recently that is all traders talk about on social media these days, fair value gaps. So here are a few variations, and I haven't spotted these for myself. I've actually taken them from the most popular place that people learn about these and taken their screenshots and put them on this. So what statement are we making about these? Are we going to treat all of these fair value gaps in the same way, give them the same level of importance, give them the same context? If not, how are we differentiating? So think about the information that traders are taking from a fair value gap. about what's going on in the market. What is it that they're interpreting from it? And think, isn't there a better way to get that information that avoids having to make so many assumptions? I mean, the assumption people make about how fair value gaps are created in the first place is basically a description of something that's called a stacked imbalance. That's a very basic order flow concept. But if you try to identify that from a price candle, there'll be many times when there isn't a stacked imbalance. So wouldn't it be more effective to use a footprint chart and actually find the stacked imbalance? And then instead of making the assumption that there'll be a rebalancing of a prior inefficiency and unfilled orders on the other side of the book that can transact when price returns to the zone, why not go to the source and confirm if that's actually the case rather than making the assumption based on this candle formation? I mean, is it possible that FVGs will appear when they don't actually represent the underlying logic they're meant to? Yes, of course, it could sometimes be a coincidence. So instead, why not go and find the right evidence for it based on order flow or something like that? Can you see the difference? In one case, we're assigning a meaning to a candle formation and therefore making a whole bunch of assumptions that could in some situations be wrong. In other words, relying on luck in many cases. And in the other case, we're confirming the information so that we don't have to assume anything. Now listen, I don't want to get into an argument about whether fair value gaps are meaningful or not, or whether I described it in the exact way that you understand. I want you to think about the logic of what I'm saying here rather than the superficial stuff. Don't let the point I'm making get lost in, something that gets you hot-headed. I think fair value gaps can be useful in certain situations, but it's context dependent and it's just much best to rely on the source information rather than relying on a candle formation. So if you want to go into the comments, just like that chart pattern video, and try to argue with me about how I'm wrong or tell me your great results as anecdotal evidence from a sample size of 1, go ahead. But you will be wasting your time because I honestly couldn't give a fuck. So moving swiftly on. The root cause problem for all of these issues that I've explained, and the reason most traders never develop an edge, all comes down to how traders usually learn. So think about what most traders focus on when they first start learning. They want to learn the strategies, that's the fun bit, it's sexy, it's what everyone's doing videos about. But the problem is they haven't got any knowledge about the markets. They haven't got any way to filter out what's logical and what's illogical. So how can they choose which strategy to learn? Well, it's going to be based on the halo effect. They'll look at which trading approaches are most popular or talked about the most online, like on social media, everyone is learning the same exact fucking approach. Or they'll look at which people teaching certain methods look most successful or sound most confident, who has the most testimonials, or who just has the best salesperson. And as a result, they end up wasting their time, money, and effort learning things that are illogical without realizing it, because they have no way of being able to differentiate what is worth their time or not. But instead, developing a skill or acquiring knowledge is like a tree. First, you start with the roots and build your foundation knowledge. And once you have that, you'll understand what direction to go from there. So you can move on to the trunk, which are the core pillars that make up that particular thing. Then from there, you have the branches, which are specific concepts and theories that you'll be able to tell are logical because you understand the core pillars and the foundations. So you can already say, well, that theory can't make sense. That concept's a load of bullshit. And because of that, then when you get to the leaves, which are things like how you enter trades, strategies, and so on, then you'll actually have something that's meaningful because it's based on theories that are logical, that are related to the core pillars and the real foundations. And then there's a final addition, which is the fruit, which are the outputs that provide the seeds for further improvement. But like I said, the problem for most traders is that they jump straight to the leaves by focusing on strategies first. But you won't know if they're hanging on logical concepts and theories that relate back to how the markets actually work, or if they're just based on bullshit. But if you build from the bottom up, you build the right understanding to be able to instantly filter which trading approaches or which concepts are illogical, not worth learning. You can tell what things are meaningless and are just analyzing noise. You can start building your edge by developing the right skills and start treating this like a professional job rather than just a computer game. Because, I'll say it again, if forecasting the global financial markets was as simple as playing an adult version of Where's Wally or Where's Waldo, where you're just spotting patterns, plotting levels and waiting for setups, it would not be something that most traders lose at. Developing a reliable edge over the long term, something you can really depend on to build a career on, doesn't come from approaching the markets as a pattern recognition exercise. It comes from treating it as a problem solving exercise. And if you think that sounds too complex for you to learn and therefore you want to go and learn something simple because you don't think you're capable, you're wrong. The industry might have made you believe that you should keep things simple and easy because if it's too complex, you're not really going to get it. But you are capable of more. Maybe you need to remind yourself of who the fuck you are and what you're able to do, and then get to work building real skills rather than just memorizing setups and strategies and thinking that will work. So I hope that by changing the way that you think about the role of probabilities in trading, what it actually means to forecast the markets and find a trade, and the implicit statements that you're making with all the actions and decisions that you take with your trading, you can start on a much better path. So this knowledge tree that you see on screen here is just a basic overview. But if you're serious about making this work, stick around on this channel and I'll explain the entire learning path for you in detail, along with all the logic behind it and why each bit is important, what role it plays. But for now, I need to stop talking. Phew.